Many people are scared of investing because there are so many choices and it can be hard to figure out which ones are best for your portfolio. This video takes you through 10 of the most common types of investments, from stocks to commodities, and tells you why you might want to include each in your portfolio. If you're serious about investing, you might want to find a financial advisor who can guide you and help you figure out which investments will help you reach your goals. However, before we begin our countdown, we would greatly appreciate it if you would subscribe to our YouTube channel and also press the bell icon. Let's get started. Number 1. Stocks. Stocks, which are also called shares or equities, may be the most common and easiest way to invest. When you buy stock, you buy a piece of a company that is traded on the stock market. A lot of the country's biggest companies are publicly traded, which means that you can buy stock in them. Exxon, Apple, and Microsoft are some examples. Here's how to make money. When you buy a stock, you want the price to go up so that you can sell it later for a profit. The risk, of course, is that the price of the stock could go down, which would mean you'd lose money. Number 2. Bonds. When you buy a bond, you are lending money to a company or government. Most of the time, this is a business or the government. Municipal bonds are issued by local governments, while corporate bonds are issued by companies. Treasury bonds, notes, and bills are all forms of debt that the U.S. Treasury sells to investors. The person who lends the money gets interest payments while the money is being used. After the bond has been held for the amount of time that was agreed upon in the contract, you get your principal back. Most of the time, the rate of return on bonds is much lower than the rate of return on stocks. However, bonds tend to be less risky. There is still some risk, but it's not a huge one. The company you buy a bond from could go bankrupt, or the government could stop paying its bills. On the other hand, treasury bonds, notes, and bills are seen as very safe investments. Number 3. Mutual funds. A mutual fund is a pool of money from many investors that is spread out among many companies. Mutual funds can be run either actively or passively. A fund manager chooses which securities to invest in for an actively managed fund. A lot of the time, fund managers try to beat a certain market index by choosing investments that will do better than that index. A fund that isn't actively managed is called an index fund. It just follows a major stock market index, like the Dow Jones Industrial Average or the S&P 500. Mutual funds can put their money into stocks, bonds, commodities, currencies, and other financial instruments. Depending on what they are invested in, mutual funds have many of the same risks as stocks and bonds. Even so, the risk is often lower because the investments are already spread out. When the value of the stocks, bonds, and other bundled securities that the fund invests in goes up, investors make money from mutual funds. You can buy them directly from the managing firm or from discount brokerages. But keep in mind that there is usually a minimum investment, and you'll have to pay a fee every year. Number 4. Exchange-traded funds. Exchange-traded funds are like mutual funds in that they are a group of investments that track a market index. Shares of ETFs are bought and sold on the stock markets. This is different from mutual funds, which are bought through a fund company. Their price changes throughout the trading day, while the value of mutual funds is just the net asset value of your investments, which is calculated at the end of each trading session. Exchange-traded funds make money by collecting returns from all of their investments. ETFs are often suggested to new investors because they have a wider range of investments than single stocks. You can reduce risk even more by picking an ETF that follows a broad index. ETFs are like mutual funds in that you can make money by selling them when their value goes up. Number 5. Certificates of deposit. A certificate of deposit is an investment that is thought to be very low risk. You give a bank a certain amount of money for a certain amount of time, and that money earns interest. When that time is up, you get your principal back plus the amount of interest you agreed upon. The longer you take to pay back the loan, the more likely your interest rate is to be high. Even though the risk is low, so is the return. With a certificate of deposit, you make money from the interest you earn during the deposit's term. CDs are a good way to save money for the long term. There are no big risks because they are FDIC insured up to $250,000. This means that even if your bank went out of business, your money would still be safe. Still, You have to make sure you won't need the money during the CD's term, because there are big fees if you take the money out early. Number 6. Retirement plans. A retirement plan is a way for people to save money for their retirement and get tax breaks at the same time. There are many different kinds of retirement plans, such as 401 plans and 403 plans that are offered by your employer. You could get an individual retirement account or a Roth IRA if your employer doesn't offer a retirement plan. Retirement plans are not a separate type of investment in and of themselves. Instead, they are a way to buy stocks, bonds, and mutual funds in two tax-advantaged ways. The first one lets you put away money before taxes. The second one lets you take out money without having to pay taxes on it. The investments carry the same risks as if you bought them outside of a retirement plan. Number 7. Options. An option is a way to buy a stock that is a bit more advanced or complicated. When you buy an option, you buy the right to buy or sell an asset at a certain time and for a certain price. There are two different kinds of options: call options, which are used to buy assets, and put options, which are used to sell options. As an investor, you lock in the price of a stock in the hopes that it will go up in value. But an option comes with the risk that the stock could also lose money. So, if the price of the stock goes down from what it was at first, you lose the money from the contract. Options are an advanced way to invest, and regular investors should be careful before using them. Number 8. Annuities. When you buy an annuity, you buy a policy of insurance that gives you regular payments. Most of the time, these payments come after retirement, but they are often bought years in advance. Because of this, many people use annuities as part of their plan to save for retirement. Annuities come in numerous varieties. They could last until death or for a set amount of time. They might need premium payments every month or just one payment up front. They might have some connection to the stock market, or they might just be an insurance policy with no direct connection to the markets. Payments can be made right away or put off until a certain date. They can be set or changed. With an annuity, you can be sure to get an extra stream of income after you retire. But even though they aren't very risky, they don't grow quickly. So investors usually think of them as a good way to add to their retirement savings rather than as a main source of money. Number 9. Derivatives. A derivative is a type of financial instrument whose value is based on the value of something else. It is a contract between two people, like an annuity. In this case, though, the contract is an agreement to sell something in the future at a certain price. If the investor buys the derivative, they are betting that its value won't go down. Derivatives are thought to be a more advanced type of investment, and institutional investors usually buy them. There are three main kinds of derivatives. Contracts for options. The options contract gives the investor the chance to buy or sell an asset at a certain price at a certain time in the future. You can buy the asset at that price if you have a call option, and you can sell it if you have a put option. Futures contracts. Futures are agreements that say a sale will happen at a certain time and on a certain date. Swaps. This is an agreement between two parties to trade future cash flows. If you are on the right side of changes in prices, you can make money by investing in derivatives. For example, if you agree to buy copper for $1,000 in 9 months but the market price at that time is $2,000, you've basically doubled your investment. Number 10. Commodities. Commodities are physical things that you can invest in. They are common on futures markets, where producers and commercial buyers, or professionals, try to protect their money by buying and selling options. Before investing in futures, small investors should make sure they understand them well. Part of the reason is that investing in commodities carries the risk that sudden events will cause the price of a commodity to move quickly and sharply in either direction. For example, political decisions can have a big effect on the price of oil, while the weather can have an effect on the price of agricultural products. The bottom line. There are many different ways to put your money to work. Some are great for people who are just starting out, while others require more research and experience. Each type of investment has a different level of risk and reward, so no matter what your goal is, you can choose one or two good options. Before deciding how to divide up their assets, investors should think about each type of investment and how it fits with their overall financial goals. That's it for today. We hope you found our video interesting, If you did, please give it a big thumbs up and share it with others. Also, if you haven't already, please consider subscribing to our channel. Don't forget to turn on the notification bell so you don't miss any of our new uploads. In the end, thanks for watching, and see you next time.